In the spring of 2016, the EDHEC Infrastructure Institute Singapore, with the support of the Global Infrastructure Hub, a G20 initiative, launched a global survey of infrastructure asset owners and managers. 184 individuals representing asset owners, managers and other actors such as multilateral and commercial banks, credit rating agencies and consultants responded to an online and telephone campaign that aimed to capture a wide and representative set of views in the sector. Amongst institutional respondents, 94% have assets under management of at least $1 billion, and 67% have at least $25 billion under management. The largest respondents in the sample have as much as $500 billion of assets. This is by far the largest and most representative survey of investors active in the infrastructure space to date. Half of the survey respondents are institutional investors. 1/3 of these are insurers, and another third represent defined benefit pension plans. Defined contribution schemes, sovereign wealth funds, and family offices and endowments make up the rest of the sample. Together, these respondents represent a cumulative $8 trillion of assets under management. 80% of respondents are experienced investors and have already been investing in infrastructure for an average period of 10 years, some for 25 years. More than half of them invest at least 2% of their assets in infrastructure, and 15% already allocate more than 5% of their portfolio to infrastructure debt or equity. Finally, at least 2/3 of respondents intend to invest more in infrastructure in the coming years. It's fair to say that this survey is representative of the population of larger, more sophisticated investors who've been active in the alternative private space for some time and have already gained a certain exposure to infrastructure investing. This is in contrast to the rest of the institutional space, where infrastructure investing remains a rarity, according to the most recent OECD surveys. We asked asset owners and managers dozens of questions about their investment beliefs, objectives, and issues with infrastructure investing. In this video, we focus on some of the answers provided by asset owners only. A first set of results suggests strongly that large institutional investors are convinced by what we call the infrastructure investment narrative. The majority of asset owners agree that private infrastructure debt and equity stakes constitute asset classes in their own right, different from other instruments or underlying assets. However, they remain very split about whether it makes sense to think of public equities and bonds, known as listed infrastructure, as an extension of their opportunity set. Less than half believe that listed infrastructure has distinctive characteristics. This lack of conviction about selecting stocks based on industrial classification is in line with respondents' widely held belief that what makes infrastructure investments unique is not their industrial or tangible dimension, but the contractual nature of their business model. This point, which has long been argued by EDHEC, is also reflected in the definition of qualifying infrastructure investments put forward in June 2016 by European regulators in the context of Solvency II. It's contracts, not concrete, that matter. The range of expected returns reported by investors also confirms this view. The weighted average required equity returns are higher for infrastructure investments that carry higher business risk and are less advanced in the development of their business. However, the range of reported required returns for comparable investments is significant. Investors differ fundamentally in their perception of the nature of the risk profile of infrastructure investments, with some willing to argue that infrastructure assets should be expensive since they are expected to yield predictable payoffs, a valuable characteristic in an asset-liability context. But still, a majority of investors see infrastructure as a source of relatively high returns. Indeed, today, most asset owners report choosing to invest in infrastructure primarily to achieve two objectives: diversification and risk premium exposure. Other objectives that are typically associated with the infrastructure investment narrative, such as duration or inflation hedging, are not particularly high on the average investor's list of objectives from infrastructure investment, even though they are for some investors. Investors are also evenly divided between preferring investing through a manager or taking a more direct route to access the characteristics of infrastructure investment. While this is partly a matter of investor size and experience with infrastructure investment, the sometimes agonizing decision to delegate or not to delegate investment management in infrastructure is also a reflection of investors' relative inability to benchmark portfolios of infrastructure assets, and more generally, to know what to ask infrastructure managers to achieve. Our survey reveals that while asset owners are more than willing to invest in infrastructure, they find themselves faced with a wide information gap in terms of expected risk-adjusted performance. In turn, this is one of the most important hurdles preventing private long-term investment in infrastructure. The immense majority of investors are not satisfied with existing products and find that they only partly fulfill their needs as asset owners. Infrastructure private equity funds in particular, which have been the main route to investment for asset owners who do not switch to direct investment, are viewed as obsolete and not generating value by 80% of asset owners. Performance reporting is highly problematic in the private infrastructure investment space. So much so that more than half of asset owners who responded to this survey did not trust or did not know if they could trust the net asset values reported by their infrastructure managers, implying that they're not sure about the level of performance or risk taken in such investments. Risk metrics in particular are reported to be ill-documented and in need of improvement. As a result, 94% of respondents agree that there are currently no usable benchmarks for infrastructure investors to understand risk-adjusted performance and determine what role infrastructure investment might play at the total portfolio level. The next generation of infrastructure investment products needs to address the shortcomings identified while responding to investors' clearly identified demand for infrastructure assets. The work done by EDHEC Infra to develop risk-adjusted performance measures for investors in private infrastructure equity and debt will help develop such products. EDHEC Infra is putting forward advanced tools and models to forecast and discount the cash flows of infrastructure firms, a reporting framework to collect data consistently at the global level, and from 2017, the publication of reference portfolios or benchmarks providing a clear and transparent view of the risk-adjusted performance of private infrastructure debt and equity. With these tools, new products can be developed that are built on the basis of what is known to be achievable through infrastructure investment. Set clear investment goals using metrics that make sense from a total portfolio perspective, and can be monitored against comparable benchmarks documented with the best available data.